Welcome back to Global Eye. Today we're looking at a financial standoff that could redefine the rules of the global economy. For years, the West has looked at billions in frozen Russian assets as the ultimate piggy bank for Ukraine. But as Brussels moves from freezing to seizing, a group of European nations is sounding the alarm. Is this a strategic masterstroke? Or are we watching the slow-motion suicide of the euro-dominated financial system? Let's follow the money to Euroclear. The €210 billion question, the alliance financing the war in Ukraine, is facing a fundamental crisis of trust. 7 EU members, including Italy, Hungary, and Slovakia, are moving to block the expropriation of Russian central bank assets held at Euroclear. This isn't just a debate over war funding. It's a collision between geopolitical necessity and the bedrock of international banking. In Berlin, a negotiation marathon continues between Ukraine, the EU, and the UK, with the US acting as a mediator. While officials speak of progress, the reality is increasingly desperate, with the United States effectively stepping back from direct financing. Europe's fiscal limits are now visible without cosmetic filters. Why Euroclear matters. Euroclear is not just another bank. It is a financial market infrastructure, FMI. Based in Brussels, it acts as the central plumbing for the global financial system, settling trillions in securities transactions. Total frozen Russian assets, approximately €210 billion, held at Euroclear, approximately €185 billion. Legal status, most have matured into cash, making them a tempting target for seizure. The illusion of the reparations loan. The plan pushed by EU Commission President Ursula von der Leyen is as simple as it is dangerous. Use these assets as collateral for massive new loans to Kyiv. This reparations loan would effectively force Russia to pay for the war today, under the assumption that they will eventually be forced to pay damages. However, major creditors like Germany and France are already overstretched, running deficits between 4% and 6%. If this Gordian knot isn't cut soon, the Ukraine project faces fiscal collapse. The systemic risk, a financial super-GAU. Resistance is growing because the stakes extend far beyond the current conflict. Expropriating sovereign reserves would violate the principle of sovereign immunity, the idea that a state's property is sacrosanct. If this line is crossed, 1. Total loss of credibility. Global investors may view euro-denominated assets as political liabilities rather than safe stores of value. 2. Bankruptcy risk. If Russia successfully sues Euroclear in international or domestic courts, the clearinghouse could be rendered insolvent, triggering a domino effect across the European banking system. 3. The oil curse, parallel. Just as resource-rich nations fear the oil curse, financial hubs fear the trust curse, where one political move destroys decades of institutional stability. The brink of a new era, Europe has maneuvered itself into a financial dead end. Without credit guarantees, Ukraine risks insolvency, a scenario that would hit European banks like a nuclear detonation. Yet the alternative, breaking the merchant law principles that international transactions rest upon, could be even more destructive in the long run. Brussels is already acting as a sovereign bond issuer, pushing for European war bonds to absorb these liabilities. Whether through Euroclear or joint debt, the European taxpayer is increasingly the one left standing when the music stops. To conclude, Euroclear is the line that Europe cannot cross without breaking the very foundation of global trust. If the neutrality of sovereign reserves is gone, is any asset truly safe? We want to know your thoughts. Is seizing these billions a fair price for victory, or is the cost to the global financial system too high? Drop a comment below, and if you found this deep dive helpful, hit that subscribe button for Global Eye. Until next time.